I'm Sarah Borkson-Keto with NAREITsREIT.com, and I'm here in Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. I'm here today with Cydney Donnell, Director of Real Estate Programs at Mays Business School at Texas A&M University. Thanks for joining us, Cydney.
Great to be here.
So starting off, where would you say we are in the overall real estate cycle at the moment?
You know, I don't really worry about it too much because I don't think that's the question. There's been a lot of sports analogies about how we can go extra innings or into overtime. But the reality is we've been experiencing a 35-year super cycle in the bond market with interest rates declining. And as a consequence of that, I think we're seeing a super cycle of money flowing into real estate. And that's going to continue to be very supportive of real estate values. We've hardly even begun, I think, the process. If you look at major institutions around the world, they're still allocated to real estate. So yes, we might have a little cyclical, bounce back and forth a little bit, but supply is pretty muted. And I just don't really think that's the question. I think if you're an investor, you want to have some money in real estate, and if you're an individual investor, the best way to do that is with a REIT.
And how would you explain the disconnect we're seeing between public and private market valuations?
Well, they're totally different markets. They are really priced with different mechanisms. The public market, you get instantaneous pricing. The private market is transaction-based, that these transactions occur with relative infrequency. And so any kind of changes in perceptions of investors of what values of real estate should be, it takes a while for that to get captured in that market. In the public markets, it's just an instantaneous thing. It's also different capital sources that are playing in those two markets. With the REIT market, you can have investors who are in it just for a short period of time and then out. And then you have certain and other investors that are in there for the long haul. But with the real estate markets, they tend to be much longer in their focus. And it takes a longer time to make your investment allocations, and then you want to work with it and keep it in there. So we've seen these many over the decades. I guess I've seen discounts as wide as 40% and premiums as about as high as 10 or 15%. And they just ebb and flow based on where's capital moving and what's the emotional context in which the two markets are operating.
And do you expect foreign capital to continue to put pressure on asset prices next year?
I think we should continue to see the flows in from foreign capital. I think one of the best markets I can describe is Houston, which people really ran away from after the concerns over the oil prices. U.S. investors, institutional investors in particular, just threw up their hands and said, oh, this is not the place to be. But when you look at what's going on in Houston now, despite the softness in that market, there's still money flowing in from Latin America. There's still money flowing in from the Middle East. And they're viewing the U.S. as, again, a long-term place to put their money. They like the lower risk. They like the transparency. They like the income-producing aspect of the asset class. And let's not forget, there is a psychological benefit to owning something that is tangible. A lot of these countries do not have well-developed capital markets. It's not as trustworthy. And yet, when you're in the United States, you not only have the great rule of law, but you've got a physical asset that you can touch and feel.
Okay, thanks very much, Cydney.
Thank you.
And for more news and information on REITWorld 2015, be sure to visit REIT.com.